Okay, so let's discuss in this video when would be the best times for you to take trades applying pretty much all the strategies that I talk about. Now, this would apply to Forex, this would apply to trading Nadex, it would apply to the EMA6 strategy, it will apply to the 61.8 ones, even the wick strategy that I have on how I trade. Which I apply mainly to the Euro JPY pair or any of the currency pairs that produce a ton of wicks. AUD JPY has done quite a lot of it this week. It would apply to all the reversals strategies that we're doing. There is a new strategy, not a new one. It's been around for a number of years. I've known about it for a couple of years. I haven't really shared it yet, not my own. But it's something I've come across, very good strategy, which is the Babon slope one. I'll share that soon. Now, any of these strategies, we're always talking about when is the best time. Now, in the past, when I've been asked about this in various videos and comment section and in emails, what I have said is that there is no specific time. It is dependent on the market establishing the right structure and giving you the right market conditions to be able to go ahead and to trade those strategies, right? So today we're going to jump into when possibly would be a great time to be trading all of these strategies, right? So if we can go back to tying in the whole market cycles, the Elliott wave stuff with applying the right strategy at the right market conditions, and also the video that I'm just about to put up, which is being processed right now, which is to do with understanding the official trend. If we can combine all three of those tidbits of information, you can work out when would be a great time to trade. Now, let's go back to Elliott wave first, market cycles. Now, all of these strategies, so what I'm about to say would apply to pretty much everything that's on my channel. Now, and also pretty much the bulk of the strategies that you will be coming across, even if you're using indicators, it's still okay. And in particular, excuse me, you might be able to use this with your stochastics as such, because even in the market showing you overbought or oversold, you can apply this bit of information to that. If it doesn't line up with this, if this doesn't line up with that and vice versa, then that's possibly a hint for you not to take that trade, right? So what we're looking for is this. First of all, you're going to identify the right. You can identify the right market cycle. You can identify where the market actually is based on, if there's a double bottom, market climbs, pulls back and is on a climb somewhere here. You can identify where that is. And once you have, say for instance, these are the trends. This bit here is a trend. This bit here will be a trend. And then this bit here will be a trend, right? Where you want to apply some of these strategies would be in these bits. Okay, you could, again, if you're savvy enough and you are trading the right currency pairs, for example, the pound pairs, pound JPY, pound USD, pound AUD, pound NZD, I think pound CHF as well. Any of those pairs, these points that are pullbacks, which is from 1 to 2 and 3 to 4, what you're going to find is that these points can actually run for up to about between 30 to 50 pips. Sometimes it will just be 1 or 2 big candles. Sometimes it'll be a host of tiny candles. So, even things like this or these situations here, these candles pulling down, you could apply those strategies. Now, the official trends usually look like something like this, where you will see a whole heap of specific candles going in one direction, right? Those would be these ones here. Sometimes you get situations like this. These can be confusing. If you're seeing too much of this choppiness, you might want to avoid the trades. You could trade them. Here would be opportunities for you to do your EMA6 strategies when the market's pulling back slightly. But the official best time that I would recommend for you to be applying all of these trades, again, thank you, again, would be in these moments, from the fourth wave of the double bottom, and then this wave from 2 to 3.3 to 4 to 5, right? So how you would identify them, this is actually the double top formation that's happened. What I like about this particular move from here to here is that there's a line of red candles, and here's how you can trade them. For those of you that trade, say, Forex or Nadex, what you're looking for is where you understand that all of this movement up, it has been from point, say, 1 here to 0.5, and now you're expecting for the market to start doing wicks to the high like this, up here, up here. These are stop hunts, okay? And also, well, you probably wouldn't have seen this one yet. So let's say, for instance, you do a stop hunt high and the market pushes back down again, and you're expecting that this is now the 0.5 going into a double top formation. Then what would you'd be looking for, and you can use your Fibonacci here. What you're probably looking for, you can draw from the bottom to the top. You can actually also do it from the morning or the Asian session. So I always do it over a 24-hour period. If I'm not doing this over a full from point 0 to 0.5, then how I would do it is do it on the official morning of that day. So I do the Asian session, and then this is the official top of or the high of the present day, and it's also the high of the London session. So I'd wait for that. If it's coming down, hitting past my 50 or the 61.8, then I'm going to look for an opportunity for this to start climbing up, because that's what I'm expecting now, that the market will climb up. To some point, it will give me another peak to the high. This is the London session, and so what I would expect is either it's going to happen at the end of the London session. If I want to make sure that there is going to be something specific that the market makers or the dealers are lining up, I'll check news and see if there's going to be specific releases for either the euro or the USD. So with the market open, it's most likely going to be a US release. If there's something specific there, then what I will be expecting is that the market may consolidate up here, go up for a hit to the high like it did here, and then start pulling back down again, right? So what I would do is, at some point, I'd wait for the market to show me clearly at least 2 candles. If it's gone past the 61.8, I want to break back into a range above the 61.8, so you want to wait for a candle to hit that. How I trade this, and this is again, guys, where you would start to look for opportunities to take all of the strategies, start applying all of the strategies. For the EMA6 guys, you'd possibly jump onto a 1-minute chart after having studied this, and you know that these candles are going to push up. So you've got maybe, in this case here, let's say if we count from this point on, here's an hour, 15 minutes. You got an hour roughly to find 3 opportunities, and this is going in towards the middle of the London session, right? So what we're doing is, and this applies to all strategies, when you know this market's going to push up, you've got your fibs drawn in. I'm going to wait for this candle to open, push down past my 61.8 line here, or it doesn't matter what line this is, number this is. It's going to push past below this line here, and I'm going to now look for an opportunity to do a call. So that's where on a 1-minute chart, you guys can jump in and look for possibly a harami pattern, and the harami would be where this is going to be after this 30 minutes here. It's an uptrend, right? Harami would be when the market comes down, and then you still have your EMA6 line piercing through possibly the following candle that's pushing back up again. And so if you take that trade, most likely this is going to continue going up for a few minutes, right? And then you keep doing it each time. See here, I don't know if you can see clearly enough, but this candle opened up, came down and hit the line again on the 61.8. If it comes down, hits these lines, this is where you take a trade. So here's one that opened and came down below the 61.8 line. This one came down and hit the 61.8 line. This one opens up and comes below the 50% line here. These are where we're taking our trades, right? You want to be able to do it at a decent buffer, because sometimes what you're going to find is that candle may open, come down, and give you a bit of a doji, or come down and give you a bit of a red candle. you want to apply enough of a buffer to be able to withstand not getting a loss. It's like, it comes down, even if you're in the money by just a few micro pips, you're still in the money. That's what we're hoping for. So I would personally, on the 15-minute charts, take my trades once it comes back down here below these lines, possibly even covers a significant part of the body of the previous candle, and then you hit it for a call here. This is a perfect area because not only is it bouncing off the EMA 6, but it's also bouncing off the EMA 50, right? And then you take a trade going up. The Babon slope strategy that I was speaking to you guys about, and that video is going to outline this more in detail. But basically what I do is combine everything that I've just spoken about in the last few videos and pretty much all of my videos. And what I'd say is there's a trend going up, candle opens, comes down, it hits both my Babon slope line, which is this green line here that you can see, in the green and white line. So this green line here, this green line says to me this is an official uptrend right now that I'm trading. Also, I've got my EMA 6 line here, the yellow one. So if it opens, comes down, and goes below the yellow EMA 6 and my Babon slope line, and everything else that I want to apply criteria-wise is met, that's when I hit it for a call, and the market will continue going up. So that's how we would actually do that. And here's 1, 2, 3. This one possibly not. You could take a trade, but possibly not. This one's another 4. 4 opportunities for me to take a 15-minute trade. And for those of you that are doing the EMA 6 one, you can do it then as well. Other times that you want to trade, so this is where you'd look for trending opportunities, which would be most likely at some point in the London session. You want to do it. You want to make sure you do it on the waves between the fourth wave of the double bottom and the double top, so that to point 1, from point 2 to point 3, and from point 4 to point 5. Okay, so that's where you'd be looking for your official your trends to happen. They can happen, guys, pretty much during any session. All right, if you can do your analysis well beforehand, you'd probably have some idea. So if this is going up and this offers me a wick to the high and then the market's pushing down, I can reasonably assume that throughout the New York session, or the half anyway, when the market's still or there's a dealer still at work, is where the market's going to come down. Now, then I'd be expecting somewhat of a pullback, most likely during the Asian session, given what currency pair it is. So that would be then wave 1, 2, 3, that sort of stuff. That's where you're looking for opportunities. This is ideal, absolutely ideal. In these situations here, you can find sporadic moments, and for EMA 6 traders, where you'd be looking for these again is on a 15-minute chart where market opens and then moves up. It's somewhere close to one of these lines, the Fibonacci lines, either hits it, moves past it. Jump onto your 1-minute chart and start looking for opportunities for that to come back down again, right? Especially if it's like this. This is the fifth wave. Market goes into double top formation, and this is now officially the fourth wave of your double top, right? So it's coming down to point 1, somewhere down here. If you're looking for those opportunities, take them there. The reason for them is really that once the market has committed to a directional flow, that means there's billions of dollars behind it. So even if the market comes back down briefly, you know there's a crap load of cash in the market to ensure the momentum continues. And that's what we want to do. Remember, in some of the videos I've been talking about what you do with a 5,000-pound gorilla. You let it do whatever the hell it wants to. You just kind of ride along with it. This is what we want to do. You want to be able to tap into the pulse of the market and understand its own momentum. And all you're doing is, when you see the signs that the momentum is happening, you're pretty much just piggybacking off of it. Jump right off of it. And every time you're in front of your charts and you're analyzing, you're studying it, look to see how the market moves in real time. There will be knee-jerk reactions. There will be bounces. Now, you know how when we're talking about where people are taking trades at times off the 61.8 line, and they'll be like, hey, you know what? This just continued right through. Why did it do that? This is what we're doing here. We're applying market cycle to it. And when you understand if the market is moving up, and say for instance here somewhere the market's coming down, but this is eventually going to move up. Actually, that's not a good good example. I don't have one in. Okay, let's get rid of this line. Let me try and see if I can show you that. Okay, so if we use this, for example, let's draw in the 100 there. We'll pull this down to here. Now notice how this candle here bounces off the 61.8. Now here's what we're expecting. This is double top, markets come down, say this is 1, 2, 3, 4, and this is still heading down. Market pushes up, we've got an EMA 50. Now what I would be expecting is that if this is 5, then we'd want market to go up, come back down, and then start moving up, right? Chances are this is an extended version of the fourth wave, and we will see. In order for this to be justified now, we jump onto a higher time frame and see if we can clearly see. Okay, this would be, say, 1, 2, 3. If this is 4 up here, well, it's just 2 candles. If this is 4, then we'd say 5, and this would be an extension of the 5 down here. So what we'd want to do is look for a movement, maybe another push down, a wick to the low before the market climbs. We've got 3 wicks to the low here. Usually that means that's where the market doesn't want to go, right? If we jump onto an hour chart, well, there's nothing clear on the hour chart, so we go back to the 15-minute chart, right? Now, here's again where we're tying this in. This hits the 61.8 line. Now, if I know in line with my analysis that this market is still going down, the official trend is still down because this is going to move in 5 waves for me, then what I'm expecting is that this is going to push up and then push back down again. This is where I would draw my 61.8 line in using my Fibonacci ratio, and then look for a bounce off. So if the market pushes up beyond my 61.8 line, that's where I'll take a reversal. But say for instance that the market is officially still on an uptrend, right? Say somewhere here. And I'm trying to draw my 61.8 line here. I'm trying to draw my ratios this way. Say, for instance, I did the 100% line and the market came down here, did the bounce down here, and then I reversed the fib, and the market started to climb. And I'm looking for a fib bounce this way, especially when the market's on an uptrend. Chances are that the market just could blatantly push past your candlesticks like this and not create too much of a wick, or enough of a wick to give you a bounce of the 61.8. Why? Because you're pretty much trying to trade against the trend here. If you trade in line with the trend, where we're doing the bounce off a downtrend and the bounce is officially to do a put, you've just increased your chances of winning that trade. So those are the great times to be applying specific strategies. So remember I said in the first video about understanding market cycles and then trading in line with them. Well, this is what it is, where this is part of the market cycle, and you will then select this to be an appropriate market condition to then apply the right strategy, which in this case would have been the 61.8 bounce, or the reversal there, onto that, and that is what increases your chances of nailing that trade, right? So again, you want to look for your trends, use the Elliott waves to do that, assign your trades to the right market conditions, make sure that the official bounces off these points here, so these 2 here, the 4 here, that's happened appropriately. The other thing that you want to make sure is where you actually trigger off your trades in relation to the sessions. So again, depending on currency pair, if you're trading Euro USD, you're more likely to take these sorts of trades off either the London session or the New York session, and then again align that with your the market cycle. The other thing is look for specific, very clear movements, and when you see them, that's when you start applying those strategies. For AUD, USD, AUD, JPY pairs, you're more likely to be able to find the right sorts of setups happening during the Asian session and the London session, AUD, JPY, more so during the Asian session. That's not to say that these setups don't happen in London and New York. It's pretty much evenly balanced because the market will move according to its own cycle, and the dealers will do whatever they're doing, but you're more likely to find the appropriate setups. Now, again, here's the other thing that you want to be mindful of. The currencies that you're trading, they need to correlate with the session that's happening right now. So, for example, right now we're still in the London session whilst I'm recording this video. So what I'd be looking for is AUD JPY, for example. There'd still be moves happening there, but I would not think that there'd be so much liquidity in the market for me to be able to do that. See here, where even here, when the London session was closed, there's still big moves that were happening for AUD JPY. Now, the Tokyo session possibly would have closed somewhere around here, okay? But this move still continued on. So the market will still move, but you want to look for strength if you've got specific strategies that you want to apply. So if you want to do a massive call up here somewhere, yeah, market may move, but you want to also say, is there significant liquidity in the market because the Australian and Japanese sessions really aren't happening right now. So you want to apply some of that correlation as well. Select your currency pairs wisely, and then apply the right strategies during those phases. So start, end of sessions, not the New York one, mind you. The open of New York is a fantastic time to be looking for setups. So is the open of the London session, and look for your very clear, concise movements. Notice how with AUD JPY, this sort of behavior, when the market's extremely choppy like this, you pretty much want to take a break from the market, because I'm not too familiar with any strategy except the reversals of, say, the EMA 200s here, where you can draw your support and resistance lines somewhere and then just trade the bounces that are constantly happening. That is a very choppy market. That tends to happen. When we're talking about these Elliott waves, we're talking about different seasonal levels that exist, and at times this sort of stuff does happen because of that. When the market's extremely choppy, there aren't any specific strategies that you can apply to that sort of stuff. Again, find a currency pair that you can work with if your favorite ones are behaving this way, and then look again for something that's familiar, apply it to market cycles, practice your timings, practice which session works really well for you. If you miss those right trades, because you weren't there, forget about it, don't worry about it. Certainly analyze them, study them. But once again, just to finish off the video, you're looking for those movements according to the Elliott waves, market cycles, and clear trend runs that are happening. Okay, once you see those trend runs, go ahead, apply your trades. For those of you that are trading London, New York, you possibly will find them on any number of currency pairs. All right, it should be enough for you to be able to get your 2 or 3 trades in for the day. Okay, if you look at it on a number of correlated currency pairs, you'd have ample opportunities for you to be able to take your 2 or 3 trades quite easily. All right, hope everything I've said makes sense. If it hasn't, please do ask questions below this video, and I'll try and answer them as much as I can. Okay, so yeah, that's it. For those of you guys that are trading the lower time frames, 5 minutes or less, this can apply, not so much, but this can apply to you guys, because the official trends, I think, start to happen on 15-minute charts and higher. All right, and you guys, all the best.